All right. So again, welcome to our morning meeting. We're gonna talk about the monthly market report through KCM, which is Keeping Current Matters. All right. If you're not familiar with KCM, you should be familiar with KCM. Go and register on their website, and they have plenty of resources for you to take advantage of in terms of um, educating yourself and as well as your clientele. Get in the habit of making a video, even once a month, making a video. It doesn't have to be a very long video. It doesn't have to be a 20-minute video. It could be, a short video, even just a 2-minute video, even a 50-second or 60 seconds short, YouTube short or Instagram short or so forth. But get in the habit of that. All right. So this is the monthly market report. The title is May 2025. I suppose the data is from, April and before because we're only in the middle of May. Let's talk about home prices. So 70% of Americans are concerned about potential housing market crisis, a crash in 2025. How many of you have heard about your buyers and sellers talking to you about crash, especially buyers that are waiting for crash? Anybody out there?
Definitely. Yeah, definitely.
Yeah, I hear that like every other day. The honest truth is that's just not a reality, and you'll see that in I haven't gone through this report, but I assume that the report will talk about that. That's not a reality. That is completely unfounded. These fears. I don't know if they're fears or they're hopes because the buyers have hopes. Uh, all right. 32% of those who planned a major purchase this year say they're now delaying it. All right. So 1/3 of Americans who plan to do a major purchase, such as a house, a car, perhaps furniture, they're saying that they're going to delay that, including 1 in 4. So that's roughly 22% or 25% who plan to buy a house. All right. About 22% of Americans who plan to buy a house are saying that they're going to delay it, and 1 in 8, 13% are saying who plan to sell a house, they're saying that they're going to delay it. All right. Though many Americans believe the housing market is at risk of crashing, economists who study housing market conditions generally do not expect a crash in 2025 or beyond unless the economic outlook changes. All right. So this is from Business Insider. So economists and experts don't think that that's likely to happen. There's just generally not enough supply. There are more people than housing inventory in inventory, and that's economics 101. If you've taken an economics class, one of the things they teach you is supply and demand equals price. And we see that on a very small basis. If you've ever taken an Uber in a rainy or nighttime or whatever, busy rush hour time, the price goes up. Why? Because the number of people looking to get an Uber is more than the Uber drivers on the road. And so what Uber does is they adjust their pricing, right? And that's exactly what supply and demand equals pricing means. When you have more supply, imagine there are 100 bananas in the market, but there's only one person looking to buy banana. What do you think the supermarket owner is going to have to do? They're going to have to drop the price because nobody's buying bananas, right? Or rather, not 100 bananas, but 100 banana sellers in a flea market or in a rather a fresh market. There are 100 banana sellers in a fresh market, farm market, and there's only one person looking to buy bananas. Well, those 100 sellers are going to have to drop their price in order to attract this one buyer. On the other hand, if there was only one banana seller in a fresh farm market and there were 100 buyers looking to buy bananas, well, guess what that one seller's going to do? What do you think that guy's going to do, the one who's the only banana seller, and there are 100 people trying to buy his bananas?
Bring
They're
it
gonna
up.
raise that price.
They're all going to
And
jack up the price because they know that this guy has no choice but to, uh, but to
buy
buy.
those bananas. Yeah.
Exactly. There's only one seller and there's 100 buyers, so they're all going to have a bidding war. That's economics 101. They teach you that in economics class the first day. The supply of homes for sale is improving, but still slow. So the number of houses in the market is getting better, but not fast enough. All right. So this is a percent of national inventory change year over year versus pre-pandemic, 2017 to 2019. Compared to, so we have 30% more houses compared to last year, but we still have 16% less houses than before the pandemic. So we're still not where we need to be, but it's better than last year. Home price growth will moderate due to more supply coming onto the market. Having income and wages rise faster than home prices are welcome to improve affordability. So home price growth will moderate. So home prices going up will continue to go up, but not as much as before because more houses are coming in the market. Remember that one banana seller who had the monopoly in the farmers market? Well, that monopoly is diminishing because now there are 10 more banana sellers coming into the market, right? So now this one banana seller will not have monopoly, but it's still not, it's not 100 banana sellers versus 100 banana buyers. It's not equilibrium, okay? But it's getting better. It's getting better. Where were we? Right here. And then also income and wages going up faster than home prices. I'm not sure how true that is, that income is going up faster than home prices. But I guess the statement is not saying that that's what's happening. The statement is saying if having income and wages rise faster than home prices are welcome to improve affordability. Home price growth is moderating. So again, prices going up is slowing down. As you can see in February 2024, year over year home price change seasonally adjusted. In February of 2024, home prices went up 7% compared to when? The year prior, February. Okay, February 2023. Are home prices going up or going down looking at this chart?
Going down.
Okay,
Like,
one person's home prices are going down. Anybody else? So the truth is the home prices are still going up. You see that last graph, last bar says 3.9?
yeah,
That means home prices went up by 3.9%. That's what that means. However, what does the overall chart means? That means they're going up, but slowly. Okay, the rise is slowing down, but the rise is still there, right? Imagine you're walking and you're walking fast and you're walking slow. If you're walking slow, are you still walking? Yes, you're still walking. You're still walking forward, right? But you're walking slow. So that's what's happening here. So home prices are still going up, right? But they're slowing down, meaning the growth is slowing down. And the reason for that is more houses are coming in the market. Obviously, after, you know, the interest rate came down a little bit compared to 2 years ago. And so the more interest rates come down, the more houses are going to come in the market. Why does interest rate coming down affect houses coming in the market?
people have more interest if they can, they'll get a better deal.
You're talking about buyers?
Yeah,
So that's a buyer, right? So that interest rate going down, you're saying more buyers would be interested, they're going to get a deal, but that's just going to bring more buyers in the market. We're talking about houses. Interest rate going down, why would that affect sellers to decide to put that house in the market? Why would more houses come in the market?
Sellers can now move. Maybe they were holding on to their, they were worried that they'd have to pay the high interest rate, so that they didn't want to move.
Correct. Thank you and welcome, Lisa. Most sellers don't have two houses. We agree with that, right? Most sellers don't own two houses, correct? Most sellers also do not plan to buy the next house all cash. When the sellers sell this house, most sellers do not plan to buy the next house all cash. Either because they don't want to use all of their cash, but more likely they just don't have that much equity. If the seller's selling $1 million house here in the Bronx and they're going to buy a $600,000 house in Rockland, well, this $1 million house is not going to give them $600,000 cash. They just don't have that much equity. They might have $200,000 equity. They might have 250. They might have $300,000 equity. They might even have $400,000 equity. That means they're going to walk away with $400,000 cash, right? That's their money. But that $400,000 is not enough to go buy the Rockland house all cash, $600,000. Most sellers are going to have to get a loan for the next house. Most sellers, we agree with that so far, that most sellers also have 3% interest rate on their current house because they refinanced during COVID. They refinanced during COVID and they got a low rate of 3%. And so we agree with that too. And then most sellers, we know once they go to Rockland or wherever and buy the next house, they're gonna get a mortgage for 6%. So most sellers, we agree that mentally they can't see themselves giving up their 3% rate and getting a 6% rate house. That's just not, that's just not digestible to them. And so that's why a high interest rate affects sellers' decision to sell the house. And even if a seller imagine a seller is selling $1 million house, their equity is $600,000. That means that's how much they're going to walk away with, right? The $400,000 belongs to the mortgage company. That's how much they owe on the mortgage. Most sellers, if they're going to walk away with $600,000 and the next house $600,000, most sellers would not want to use all the money to buy the next house, all cash. Right? They want to have a little bit of money in the bank. They want to have a little bit of money on hand just for something, right? So for that reason, that's why the high interest rate affects the seller's decision to sell the house, and that's why it affects the inventory. All right, Freddie Mac says we expect the pace of house price appreciation to moderate from the level seen in 2024 while still maintaining a positive trajectory. So this is that line, Cassandra and others that we were talking about. The rates are still going up, but they're not going up as fast. You're still walking forward, but you're not walking as fast as you were, right? So rates are still going to continue to go up. Sorry, not rate. We're here talking about prices, right? So prices are going to continue to go up, but they're going to slow down going up a little bit because more houses are coming in the market. More houses coming in the market naturally affects the price because of the supply and demand, right? If there are 10 banana sellers in a farmer's market versus one, well, those 10 banana sellers don't have monopoly as much as one would. And what happens if 50 banana sellers enter the farmer's market, right? And there are 100 banana buyers. So again, prices will have to come down. Price growth will have to slow down. Prices won't come down yet because we don't have equilibrium. Equilibrium would happen if there were 100 banana buyers in the market and 100 banana sellers in the market. Now we are at equilibrium. And then once you have more banana sellers, we have 110 banana sellers, but only 100 banana buyers, then prices would have to come down because now there are way too many sellers. All right. Here, Lawrence Yuen, who is the chief economist at NAR, says there's just simply not enough supply. So the economics of supply and demand, if there's a shortage, prices simply cannot crash. Exactly. For home prices just cannot crash because we just don't have enough houses. That's one of the factors, by the way. There are other factors, and I'm assuming this report will talk about that, meaning people have a lot more equity in their houses these days now compared to 2008 when we really had a housing crash. And the housing crash of 2008 was due to relaxed mortgage regulations. People who should not have been able to get a mortgage were able to get a mortgage. And people who should not have been able to get certain high amounts of loan were getting high amounts of loan. And that's why we had a crash of 2008. Those conditions just don't exist. It's like saying, wow, I had a fever in 2008, so I think I'm going to get a fever now. Well, the conditions for fever are just not there, or the symptoms of fever are just not there, right? So, or whatever, right? So that's, because if the symptoms of fever are just not present, how can one be saying that fever's on the way, right? All right, mortgage rates. So let's talk about a little about mortgage rates. Stability in March, volatility in April. So this is a 30-year fixed mortgage rate. So let's just understand the chart first. This is all 2025. We are looking at March. At the bottom, you can see the March dates. They're like every 3 days apart. And the rate was hovering around maybe 6.5, 6.6, roughly around 6.6 to 6.8. The rate was hovering around 6.6 to 6.8, 6.6 to 6.8 in March. And then in April, it dipped a little bit, and then it went up to 7.5, and then it came down to around 6.8, 6.9. All right. And then Jerome Powell, chairman for Federal Reserve, says, as that great Chicagoan Ferris Bueller once noted, life moves pretty fast. For the time being, we are well positioned to wait for greater clarity. All right. Inflation easing, but remains elevated. So inflation is easing, right? But it still remains high. Federal Reserve's target of inflation is 2%. We were at an all-time high of 5.3 in March of 2022, and since then it has consistently come down to where we are at 2.6% now. All right. Unemployment remains steady. So people who are unemployed but looking for a job, that rate is around 4.2%. I'm not sure if you guys know, but the unemployment rate does not even count the people who have stopped looking. I don't know if you guys know that.
I didn't
If
know
you,
that.
huh?
I didn't know that.
Yeah, it's very it's a little bit misleading. So let's imagine there are 100 people in a society who don't have a job, right? Completely don't have a job, but 70 of those are looking, and 30 of them just gave up because it's been 4 years, it's been 3 years, it's been 5 years, it's been whatever years, and they just stopped looking. The unemployment rate does not actually count them. It only counts the people who are actively looking. I've got a friend who I think hasn't had a job in years now. He was working in IT, based out of Maryland, laid off during, cuts and stuff. And then, he applied. It took years and years and years and years, and now it's been years. I don't even know if he's looking anymore. But yeah, so the unemployment rate actually does not take into account the people who are no longer actively looking for a job. They may be unemployed, but the national unemployment rate doesn't count them. All right, anyway, so it's at 4.2%. That means 4% of the working population who is looking for a job is doesn't have a job. Expect 3 or 4 federal funds rate cuts this year. So this is from CME group, and they're saying that we should expect roughly 3 to 4%, 3 to 4 times the rate to be cut by the feds. These are probabilities for 2025. All right. The probability of a no cut is less than 0.5%. The probability of one cut is 5%. The probability of 2 cuts is 20%. The probability of 3 cuts, meaning the rate being cut 3 times, is 36%, and 4 cuts is 30%, and then so forth. So between both of these, between all of this, seems like we should expect 3 to 4 times the rate to be cut this year. All right, these are mortgage rate projections by various entities. All right, Fannie Mae says that the rate will be 6.5 in quarter 2. Mortgage Bankers of America says, or Brokers of America says it would be 7% in quarter 2. NAHB says 6.66, Wells Fargo says 6.35, and if you combine all four of them, then it's 6.63. In quarter 3, the combination of all of them is expected to be 6.47. So as you can see, it's a little bit less than quarter 2. And then quarter 4 is expected to be 6.36. This is good news for all of us. The more rates come down, the more buyers come in the market. But of course, we expect more sellers to be in the market, as we already discussed. Mortgage rates and projections. Please jump in if you have any questions, comments, feedback, any insight. All right. Mortgage rates and projections. All right. So the orange line is the actual line. That's up to quarter 1 of 2025. As we can see, the rate was quite high in late 2023, and then it came down. Why was the rate cut during COVID? Why was interest rate slashed to like 2%, 3%?
What year was that? Was that COVID or
During
can't
COVID,
say.
2020, 2021, the rate was cut to 2%, 3%. Why was that?
Was it because like no one was buying or no one, so they lowered the rate?
Okay. Right,
No one
exactly.
was taking loans,
Yeah,
supply
well,
and
they
demand.
wanted to keep the economy going, right? It's like giving an IV bag, right, to somebody who's sick, right? They're in the
Yeah,
hospital.
they were like dangling the food there
Yeah,
so that people could bite.
basically you're giving them a booster to say, hey, you know what? Here's a booster shot. Everybody's home and everybody's worried. We don't know what's going to happen. We don't know what's going to happen to our jobs and this and that. So the government's like, you know what? Here's cheap money. Like, just go shop. Here's cheap money, right? When money's cheap, you buy things that you didn't even think that you wanted to buy or needed to buy, right? So that's why there was a crazy frenzy buying houses because the rate was 2%, 2.5%, and so forth. Well, when you give away cheap money or when money is cheap to borrow, what that does is it brings out a lot of buyers in the market, right? Obviously, right? Um, you know, so now we have a lot of buyers in the market buying houses and buying shoes and buying furniture and buying everything. Well, what that does is that inflates the prices. Remember, supply and demand equals price. We have a lot of buyers buying a house, a lot of buyers buying sneakers and shoes and furniture. So now prices of all those things have to go up, which is, inflation. So now in order to bring inflation down, the interest rate has to be raised up. So that's what you see right there. The big bump you see, 2023 quarter 4, that's the interest rate going really high up. And of course, when interest rate goes up, that means borrowing money becomes expensive. And what that does is that slows the buying down, right? Buying and the selling gets affected because the borrowing money is not so cheap. All right, so now what happens going forward? You have all of these projected lines. The green one is Mortgage Bankers of America. Their forecast is at the highest. And then the yellow one is NAHB. The blue one is Fannie Mae. And then Wells Fargo at the very end. Okay? All right. Lawrence Yun, again, the chief economist at NAR, says a meaningful decline in mortgage rates would help both demand and supply, demand by boosting affordability, and supply by lessening the power of the mortgage rate lock in effect. All right. And then again, same person, Lawrence Yun says, even in an economic recession, generally home sales can rise if the mortgage rate declines. So even if we were in a recession, we can have home number of houses selling go up if the rate was to go down. All right. start more conversations, close more deals. Repeat business is falling. Percent of sellers who use the same agent again, that is going down. So that's that's certainly something we need to be concerned about. The number of people who use the same agent in 2022 was 15%. That number went to 11%, and then that number went to 8%. All right, folks, so that's it for today's Keeping Current Matters report. Most agents know what's happening. Good agents understand what's happening, and only great agents can explain what's happening. So you don't want to be part of the most agents. You want to be a good agent, and you want to be a great agent. You want to understand what's happening in the market, and you want to be able to explain to your buyers and sellers what's happening to them and what's happening to their ability to buy and sell. All right. We're gonna end here today. I've got to go take care of some stuff as well, but I thank you for joining and enjoy the rest of your day, guys.
All right, take care,
I'll share the
everybody.
video
Thank
with
you.
everybody in a little bit. No problem. Take
Have a
care.
good day.
Thank you.
Bye bye.
Thank you.